Hey team, Connor here. I'm going to talk to you today about the long strangle strategy, what it is and how we can trade it on 0 DTE. We all know markets have changed. We've been in a negative gamma, high vol, low liquidity regime for most of 2022 thus far, and this could continue for quite some time. Therefore, we're looking to add some strategies to our playbook that can benefit from the current market environment. Now, when we write credit spreads, we are short Vega, meaning we want volatility to contract. The strangle is the opposite. It is a long Vega strategy. So with this trade, we are expecting volatility expansion, either to the upside or the downside. As you can see in the profit diagram, a long strangle is a market neutral strategy and has no directional bias because we are long the call and the put. First off, this is a debit strategy, and you can trade this on any index, ETF, stock, you name it. Right now, we're trading this strategy on the QQQ, which is the NASDAQ. However, certain macro environments, the Russell, so the IWM may be better suited. We just want to go where the volatility is. Now, how do we construct this trade? You simply buy a call option and a put option with strike prices that are slightly out of the money. The more bullish you are on volatility, the further out of the money the options can be, right? You can buy those options. But we recommend buying 1 or 2 out of the money, ideally where the spread is between 3 to 4 points, right? So 3 to 4 points between the long call and the long put. When do we place the trade? The trade is an opening play right at 9:30 a.m. when the market opens. We simply select our strike prices and we enter via the ask to get immediate execution. Don't worry too much about the price because it will be a bit volatile near the open, but you will get filled at the best available price. What's the risk? If we don't see an increase in implied volatility at the open and the market consolidates and moves sideways, that's when the trade loses. We know premiums are richer at the open and that premium tends to dry up fairly quickly. Therefore, if we don't see a directional move at the open, either up or down, we will be likely stopped out. We're going to have losing trades, but how do we manage our risk? We recommend using a trailing stop on this strategy, a trailing stop limit. With a trailing stop of 20 cents and a limit of 10 cents. This equates to a max loss of $20 per contract. And this can be adjusted depending on liquidity and recent performance. But whatever the stop is, it will always be trailing. Therefore, it will, to an extent, protect our profits. For those who don't know what a trailing stop is or how to place the order, in the video description, I linked some useful information. And for those that are still having trouble, I recommend contacting your broker. All major brokers have a platform support team and they are very helpful, so utilize them. I personally use Trader Workstation from Interactive Brokers. So for those that trade on the same platform, you can reach out to me. I am able to help. What is the profit potential? Theoretically, it's unlimited, but you can expect about a 2-to-1 ratio. If you're risking $20 per contract, you can expect to make $40 on average. Now, this is going to be dependent on the market regime we are in and what happens to implied volatility, really within the first 15 minutes. Some days we are going to get huge moves at the open, and in those cases, profit potential is massive. Other days we get some more moderate moves at the open, and oftentimes that trailing stop can put us in a no-lose scenario because as the options increase in value, the stop price moves up and it can surpass our break-even point, so our entry point on the strategy. This trade duration is also extremely short, typically no more than 15 minutes. And that's one of the great things I like about this strategy. You're in, you're out. And either you made money or you lost money. You're not really hanging in limbo waiting for market outcomes. And so this is great because we reduce our exposure and therefore reduce our risk in the trade. Let's take a look at an example. So this is the option chain for the QQQ. we would be looking at 1 to 2 out of the money. In this case, we bought the 303 put and the 306 call for a net debit of 4.87. As I said, we would execute at the asking price to get immediate execution. This is the profit loss diagram for this particular trade. 3 or 4, more or less the at the money strike. And as I mentioned, we bought to open the 303 put for 241 right there, and we bought to open the 306 call for 248 with a net debit of 487. This is our maximum loss on the trade. Maximum profit is theoretically unlimited. We also have 2 break-even strikes right there and right there. This is how you calculate them, although we're really only in the trade for typically no more than 15 minutes. The break-even strikes do not really apply to how we utilize this strategy in 0 DTE. This is basically the trade. It's extremely simple. Either it works or it doesn't work. It is hands-free. After we enter the trade, we place the trailing stop and we let it play out. There you have it. That is the long strangle strategy. Happy trading.